this so you can go back and take a look at it, but preparing for live stream, just like the countdown, Paula. 5,
That's
4,
right.
3, 2. Just so you can go back and take a look at it, but all right.
No walk-on music.
I'm not that sophisticated, John. John, take it over.
Thanks, David. I appreciate you putting this together and for everybody joining. Kyle Moody is someone I've gotten to know over the past couple of years. I believe my brother introduced me, and I'm glad he did. And I think that's payback for all the good things I've done for my brother. But Kyle is head of business development. I'll let him talk about himself, but I know what he's done for me and for what he's done for my business and my investment. And I'm looking forward to hearing what he's going to cover again. Now I've done this a number of times with him with different groups, but I thought in a conversation with David and some of you guys on an earlier call, this is stuff as realtors we should be learning and teaching, learning for ourselves, but then teaching to our clients. I think if anything, it becomes something, that you can become that trusted resource for your clients and they're going to turn into potential investment partners and more deals, more dollars, et cetera. So self-directed IRAs, Kyle, I think is going to touch maybe on a little with time and on solo 401ks. I think that's something that I'm not in yet, but Kyle, I'm telling you, I want to get there. So that's all I'm going to say for now, but I'm going to turn it over to you, Kyle. Thank you again. Look forward to hearing from you.
Well, thank you, everyone. And just show of hands or a nod. Can everybody hear me really quickly? Okay, fantastic, fantastic. Listen, I was really excited to be asked to be here. It's great. I can't see exactly how many people we have on this morning, but it was really great to know that on a Friday I could end my week, at least the morning part of my Friday, with a presentation like this to give you all some good information. This is one of many presentations I've already given this week. Monday night. Ended up being a late night getting in from Charlotte. We had a live webinar that you can always catch any of our live webinars on Wednesdays at noon, which, by the way, that one does have walk-up music, and it's really cool. And then getting to end the week with you. And one thing I want to talk to you about is that it says power up your investment ability. This presentation, your clients, and you're going to benefit from this as well. There's a part I'm going to touch on that's going to specifically benefit all of you, but your clients, you nor your clients right now realize what a gift you're giving yourselves or them by showing up to this presentation. Okay. John can talk about it a lot. He's used it. You don't know me from Adam. You can see the presentation, but I'm also going to give you access directly to me and you'll see that later on via email or by my direct phone number, where you can call me and we can actually set up some side appointments, help get you geared up for yourself, or really see if there's any clientele that you're working with and how this is going to work for them. So again, I'm Kyle Moody. I'm the business development manager here at American IRA, where we specialize in self-directed IRAs and solo 401ks. And really quickly, always have to do a disclaimer here at the beginning. It's really cool when you see our webinars now, or any of our podcasts. We've got this amazing marketing guru, and so he's put together this really cool video that kind of comes out for about 30 seconds to tell you all this. I won't read through the whole thing, but just know this: I am not a fiduciary, neither is anyone else in our company. Okay, the company itself is not a fiduciary company like a Schwab or a Fidelity or Morgan Stanley or a Merrill, anything like that. Okay. So in other words, I am not permitted, even though you're going to hear a whole lot of stuff, it's only education and information. I'm not permitted to give any tax, legal, or financial advice, suggestions, or opinions on anything. I can educate you on a lot of options. If I'm talking to your clients, I can really listen to their scenarios of what they want to get into, or maybe you have qualified them and you want to talk to me before I talk to them, whatever the case may be. I'll always educate you and give you the information that you need for the options that are out there. But everyone is always encouraged to do their own due diligence, have people on their team. And when I say their team, their professional team. So whether that's going to be a CPA or a tax professional that understands the nuances of self-directed retirement accounts. Okay, that's important there as well. Attorneys that are going to be blessing certain deals that might be folks might be going into, because we are not going to broker the deals. We're not going to create the HUD statements. We are not going to put together the offer to purchase and contract. All that's going to come to us when somebody is doing an investment, and we'll tell you about that a little bit later as we get on with this. So again, Kyle Moody, I've been with the company now over 8 years. And one thing that John and I actually tripped upon, about a month ago, John, when we were talking about it. I spent 4 years in Washington D.C., and y'all, this is really something. Is that depending on how well you know John and the years that he spent in Washington, he and I actually narrowed down that not just were we on Capitol Hill together, it's quite possible we were actually, it's not quite possible. I think it really did happen. We were in the exact same hearing rooms at the exact same time, but we didn't end up knowing each other until 20 some years later. So that's really a small world right there. After I moved back to North Carolina from Washington, I did get my real estate broker's license, a multi-million-dollar producer with a large firm in the Asheville area, and still keep my license active. And then also was the broker in charge of a property management company. So I understand the investors that have the real estate there, which of course a lot of that is going to be your clientele, and it may be you as well. Did all of my education down here in North Carolina, Western Carolina University. Go Catamounts! And let's go ahead and get started on this. So, really quickly, a plug about American IRA. Why do people choose us? Okay. And John and others can tell you about this. Number one, and I just had a call with a lady this morning that's coming from a competitor. She doesn't like their high fees. And I've been told by folks who have been looking at all the different companies out there. And again, this isn't the sales pitch. It's not. But this is information that you're able to talk to your clients about and letting them know, hey, look, it's your retirement. All investors know it's not what you make, it's what you keep. So if you're looking for a company for you to be able to invest the way that you want, but you also want it to be cost effective for you, American IRA has got some of the lowest, if not the lowest, prices out there. Flat fees. It doesn't matter how much your account grows in value from the work that you or your clients did to grow their portfolio. All we are is the record keeper. Okay. We didn't do the work. You did. They did. And that's why we believe that they keep that. So our fees never increase based on the growth of their portfolio. We've got thousands of clients all across the country. If it is a retirement account, we have got the self-directed version of it, and you'll see that here in just a second. And just like this morning that you are experiencing, whether it's here, whether it's on any of our podcasts or any of our webinars, we like to be the education leader out there. So what is somebody's why of why they want to use, I mean, not even a self-directed IRA, but that you want to get out of bed in the morning, that you want to be here on a Friday morning after getting back from Disney, after a lot of closings this week, after all the things that's going on. Why are you here? Okay. Why is a client going to be, working with you? What is their why? What are they looking for? Are they looking for something outside of their primary residence? They're wanting to get into investing. Is it something new to them? Is it old hat to them? Are they looking at the stock market right now after what the economy's doing and the federal government's been doing for the past, almost month and a half? Are they thinking, golly, it gets so volatile, but is there something out there that I can have a little bit more control over? Do I have to open up a self-directed IRA and invest all of my funds? Can I break it up? How do I diversify all this? And the one thing that I really do get a lot is, well, and I hear this a lot on calls. Well, look, I'm going to be working for a long time. I'm not retired yet, so this isn't for me. Well, no, it actually is for you, and probably is more so for you than the folks who actually are retired. Or is it too late for me to start? So really quickly, And just so you know, I am going to go through the whole presentation and then I'm going to be a sponge for all your questions. And hopefully I'll be able to answer all those for you. So just hang with me for a little bit here and we'll get through all these. But um, for any of you who don't know exactly what a self-directed IRA is, I've thrown this up here. Folks will tell me from time to time, "Oh, I've already got a self-directed IRA," and I'm thinking, "Okay, great, they're at a competitor. I know I can beat their prices and I can beat their service. So let's see where they are." And they'll say, "Well, it's at Fidelity." I'm like, okay, can you explain that a little bit more? I know where I'm going on that, but I really want to hear what they think they have. And they say, "Well, I choose something and I click on it, or I'm at my guy at Edward Jones, or my lady over at Merrill Lynch. I tell them what I want and they do it. So I've directed that." Well, yes, but you are still held by the guise of the market. Okay, so with self-directed IRAs versus the stock market, where or by more traditional houses of investing, that's going to be stocks, bonds, and mutual funds. Where here it's all alternative assets. Okay, we're going to put a star by that because I'll tell you about something that we do have that you or your clients can benefit from now that we've brought back into our service, but where you've got the highly volatile, just the up and down movement of the stock market, and somebody might not know what's going to happen or why one stock might be $10 a share one day and $12 a share the next, back down to 9 after that. Hey, look, if you understand that, then you are much smarter than I am when it comes to the stock market. But I think the one thing that we can all relate to is the dirt and what sits on the dirt and the fact that they don't make any more dirt, right? And the fact that if you look at the trends of real estate, even in bad markets, guess what's happening in those revitalization markets? Real estate is still increasing, right? Sales are still out there. And if you're, pounding the streets, if you're killing it in your portfolio and working with your clients. And if you have investor clients, though they might be a little guarded right now, they are still looking for the deal. And the deal can come around at any time, right? So, where the stock market might be up, down, sideways, the tenants are in the properties and they're still paying the rent. The rent is still coming in, and landlords are still pocketing all that all that income. Well, here it's not the landlord that's pocketing it; it's the retirement accounts that are pocketing it, and all that is going into tax-free or tax-deferred accounts. And really quick, I'll tell you, what if you knew or heard about, and maybe you have heard about this, but maybe this is one of your first times hearing this, and maybe you're a seasoned investor, but either way, this is a really great thing to hear. What if you knew that you or that your representation of investor or client could use money to buy an investment property, have that property just profit month after month, year after year, and where that money went, nobody had to worry about paying any taxes? How about that? I mean, would that actually kind of, perk you up on a Friday morning, raise those ears a little bit more? Do you already know the investor who you're like, I've got to get them on the phone today or Monday morning, or send them an email over the weekend. They need to know about this, because there are so many investors that come to us that have been doing these real estate transactions, or these notes, or private lending, whatever they wanted to invest in over the years, but they've been doing it with, checking account money, savings account money. Doesn't matter if it's sitting in a savings account or if you pulled it out of a 401k at one point, you're getting taxed on that pullout. Then you're paying all the taxes on the property. Then guess what? If it's a fix and flip, the sale comes in of the property, you're paying tax on that. You're paying tax on the income year after year on the rental income, right? Well, guess what? You do something like this on the inside of a retirement account, there are no taxes to be paid because you don't own the property. Your retirement account does. And because of properties remaining inside of a retirement account, it is those retirement funds that keep it from being taxed. Oh, and by the way, that's just a traditional and Roth year after year before you take any money out. If you buy anything with Roth accounts alone, like I just mentioned, you're never going to pay a dime in taxes on that, okay? Ever. The house, you hold it for 10 years, it makes $100,000 in rent over those 10 years. Then you sell the house and it may have what accrued in value 250,000. You just made 350,000 in income that you'll never pay a dime in taxes on. That's the beauty of the self-directed IRA. And you're going to learn a little bit more about that today. So all different types of self-directed accounts, like I was just telling you. So you've got now, really, as you're looking at the screen, you're going to be concerned with more of those top blocks over there on the right, the traditional, the Roth, and the solo 401k. Okay. The solo 401k, we're going to put a pin in, and I'm going to talk about it at the end because that's the one that I was telling you that is really going to probably benefit you all the most, and maybe some of your investor clients, but this one is the one that's going to be for you. So if you hang around with me for till the end, you're going to learn something about that and how you can really benefit. And like John said, he even wants to hear about more about that one as well. Okay. Solo 401k, what I will tell you is for someone that has their own business or an entrepreneur like you with no full-time employees. But for folks who do have employees, they got their own company and have employees, then they're going to need to kind of hedge into an employer-based plan. And that's where you're going to see that SEP and that simple right there. But if you've got kids, small kids, grandkids, and you want to start building up accounts for them, and you don't want to use the 529 plan because this is not a 529 plan. This is the Coverdell, the ESA, the Education Savings Account. Health savings plan. Somebody has their own company, and if they got a high deductible health plan, that's what you have to get the HSA. You can open up a self-directed HSA. An aunt dies, parents, spouses, whatever the person, whatever the relationship, if it's an inherited IRA, believe it or not, you can actually open up a self-directed inherited IRA. And then there are some nuances on how that can be contributed to and how it can be used. Won't get into the weeds on that today, but if you do have those types of accounts, or if you have a client that has those types of accounts, you can pre-qual them, ask them some questions, get them over to me, and I'll take care of the rest, and we'll get them set up. And then a spousal. I can't tell you how many times there may just be one spouse that works, and that one spouse makes enough money to cover not only their own um, um, contributions into their account, but also they can cover their spouse's um, uh, contributions as well. So just because anybody should know that to make a contribution into a retirement account, you have to have earned taxed wages. Okay. Earned tax wages. Real estate brokers, you know that you're probably filing quarterly. Okay. Well, you're filing taxes. That means that, all that income you're filing, you have taxed income. All right. But if somebody just says, well, all I'm doing is just collecting all the rent on all my properties that I have, or I've got dividends coming back in on stuff like that, that technically won't count as money that you can put into a retirement account. That's not my call or judgment to make. That's going to be up to between you and the IRS. But just know that you have to have earned tax wages to be able to make contributions into a retirement account. All right. Traditional IRAs. I'll give you a little bit of background on a couple of these just so that you'll know. And also to let you know that when you are talking to your clientele, you can ask them a couple questions so that you know that, hey, I think that these folks, if I want to talk to them about a self-directed IRA, and I want them to be able to use this, I wonder if this person will work for Kyle. Here's just a couple questions in general conversation to ask them. Oh, well, listen, you may not have the money right here, in your pocket to get this investment property. But by the way, did you know that you can actually use retirement dollars that you probably already have, or you may have found out they've already told you, yeah, I retired a couple years ago. Well, there's your in. Oh, really? Well, do you have a 401k? Yeah, have you done anything with it? It's just sitting there. I've had no idea what I was going to use that money for. Well, guess what? You just unlocked their ability to invest in real estate with those 401k funds, and just chat them up about it. Well, listen, what are your funds that are in there? Traditional funds, Roth funds? You'd be amazed, because I ask these exact same questions. You'd be amazed at the folks who don't even know what they have. They know that they have a 401k, but they don't even know if it's pre-taxed or post-taxed. Both, don't care, whatever. But those are some of the first questions I ask. Okay, because where's the money coming from? I'm not just asking where the money's coming from to see how much money we're going to be managing, because we don't make money on percentages of what we manage, because we don't manage anything, right? So I need to know their motivation and what kind of accounts they're going to be using. Is it going to be a rollover to us from a 401k? Is it going to be a transfer from a traditional or a Roth? So just ask them, hey, will that 401k that you have, and here's something that's very important. If you've got a client and they say, hey, this really sounds awesome, but you find out that that 401k that they have is with a current employer, then they're going to need to find out if they can use any of those funds since they're still working there. And you might want to jot this down. This is the key phrase that anyone who has a current 401k needs to ask their employer, their HR department, or their plan administrator. They need to know, am I eligible for an in-service rollover? Am I eligible for an in-service rollover? And then I tell folks, hey, try to sell that off to them. Look, I'm still going to be, investing here. I'm still going to be working. I'm not leaving, but I'm looking for an alternative way to invest other than just the stocks, bonds, and mutual funds right now that I have. So I'm not taking this money out to use as my own. It is going to roll into another plan. But am I eligible for an in-service rollover? Now, look, if somebody is not vested at a company, if they haven't been there a long time, if they're younger, more than likely they're going to hear no. You're not going to be able to move that account. They may find out that, yeah, you can do it, but it's only going to be a percentage. Okay. But if somebody is retired, that is money from a previous employer, then by all means, absolutely, they're going to be able to roll those funds into their new self-directed account. And they'll say, well, which one do I choose? Well, if they've got pretty much all pre-taxed funds in a 401k, they're going to be able to open up that traditional there. If they've got post-tax funds or a Roth, they can roll it into that Roth. Or if they have a traditional or a Roth somewhere else, it can transfer in to the respective accounts with us. And traditional accounts are pre-taxed or tax deferred accounts. So that money, the taxes were never paid when the funds went into that account. Okay. You can still invest in whatever you want to invest in, and you're not going to be taxed at that moment. But when you go to take the tax or the funds out in the future, 59 and a half, and if you wait even until when you have, the government says that you have to take it at the age of 73, at least for right now, it's 73, then that's going to be income that you're going to be taking on in the future, and you'll be taxed at that moment at your tax bracket. I can't give you any of those numbers. That's going to be between you and your tax professional. For the Roth account, the taxes were paid before the funds ever went into that account, right? So not only are you buying real estate or precious metals or lending out money or getting into a syndication deal, what have you, with tax-free funds, it also means that every single cent that comes back in the form of profit, dividends, what have you, are never going to be taxed because it was purchased with tax-free money. And that's pretty powerful right there. Okay. Now, look, there are income limits on Roths. There's ways to go from a traditional to a Roth if you make too much money to be able to contribute to a Roth. Won't get into that today. Just know that it is possible. If you'd like me to talk to you or any of your clientele about that, I'll be more than happy to, again, give them the education. But for the taxes that they're going to be looking at on, say, a conversion, that's going to be between them and their CPA. Excuse me. It's been a lot of talking this week. Okay. Now, the reason I show you all those accounts and then bring you to this screen here is some folks will say, oh, well, yeah, solo K is great, or all the traditional is great, Roth. But I really wanted to, I really wanted the Roth to buy my real estate in, or I really wanted the traditional to do my note out of, because that's all I thought that I could use to invest. No. Whatever you saw on this screen here can all invest in this screen here. Okay. So it doesn't matter the retirement vehicle at all. It can all be used to invest in all these things. Number one, real estate. That's why we're all here. But believe it or not, lending is also huge. And I'll show you in a little bit why you or why some of your clients might not work for real estate. It might be something that they want to do it a certain way and they can't do it. So I'll show you other ways that people are able to invest, but all facets of real estate, okay? Whether it's single family rentals, multiple families, commercials, raw land, um, storage units, things like that. Those are huge. Um, Private lending is right behind real estate. So if somebody wants to maybe not get into the real estate game anymore, they've had enough of it, but they understand it inside and out, and they want to start lending money to people that are getting into it. You can absolutely do that. Precious metals, big. Now, for I I tell people this back then. I can't remember the actor's name. I always forget it. He was in Space Cowboys. He's been in a bunch of character actor, but he's got like the white hair, good looking guy, and he's talking about this gold company that's out there, right? Something Capital. And at near the end of the infomercial or the commercial, he's walking through. You can tell it's one of those fake living room things. And he's like, "Hey, did you know that you can get gold in your IRA?" And he's saying that as he's closing a picture on the wall behind a safe. And I'm like, "Oh, no, 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 no! We can't let people think that they can hold gold at their house, if they bought it with a self-directed IRA." And it's kind of funny how I saw that portion of the commercial not exist much longer after that. But point being is that Delaware Depository is the depository that we have a relationship with. So you can actually use your self-directed IRA to buy gold. You're never going to hold the gold. It's never going to come to our office. Nobody's ever going to touch it. It's going to go straight to Delaware Depository. So you've used your IRA to buy the gold. You're going to use your IRA to pay the shelf rent there. Okay. Private equity startups. Can you imagine if you would have used a self-directed IRA with just a little bit of money when some guy that nobody believed in was putting a box together with a keyboard in a garage in California, right? Before something goes public, you can actually invest in private companies with your IRA. Huge. You want to get into the real estate game, but you don't want to really have to worry about all the day to day. Somebody's got a, you know, 400 unit apartment building complex they want to go after in East Tennessee. And what are they doing? They're doing capital raises, right? A lot of y'all are familiar with that. Okay, guess what? Your self directed retirement account can be used as the LP investing into that greater LLC as a whole. And as the dividends are coming back in after all the taxes and all the salaries and all that stuff has been paid, that net money comes in and then they disperse that back out to the percentages according to the folks of their investment or all their investors. And in this case, it's not coming back to a human; it's coming back to a retirement account. So again, another example of how you can use that. Depending on where you are in the country, we don't do that here in North Carolina, but tax liens and deeds. But absolutely, there's foreclosures everywhere. So just know that you can do tax liens, promissory notes. Now, the reason I saved that right before I say this next one here, and here we are at 10:30 already. This is about a 2-hour presentation. I'm trying to shrink it back down into about another 10 minutes here. Checkbook IRA, also known as the IRA owned LLC. This is massive for folks who are going to do something like fix and flips or tax liens. Okay. You will never hear me bring up an LLC unless someone brings it up to me first. American IRA not only is one of the only companies that allows the use of the IRA owned LLC, but we actually have an in-house sister company that can put that together for you. Okay. It's a powerful, powerful tool because it is arm's length. It gives you a little bit more flexibility on stuff, but there are some times where certain asset classes will work better with the LLC because of the speed. Tax liens are one of those. Foreclosures, the fix and flips. Contractors do the work, they want to get paid. This puts you in control of being able to cut the checks, but the only money that's in that LLC business bank account is strictly retirement dollars. Okay. Again, I will talk about I could come back on and do just LLC talk alone. If you guys ever want to have me back, I'll be more than happy to give you a big presentation on that. Or again, you can get in touch with me and we can get you taken care of. And really quick, let me go ahead and give you a couple things just in case somebody does have to hop for a closing or something. This is my direct phone number, 828-412-8123. And I don't know if on this camera it'll show up, but right there, it's going to come into that phone. I don't know if it's a good or a bad thing that you can catch me wherever I am, but we've all been real estate brokers today or at some point, right? We're used to people getting in touch with us, no matter what. Also, my email address, Kyle, Kyle, at AmericanIRA.com. Now, look, there are some things and some people you just can't do with your self-directed account, right? So it's not so much the gift that the IRA or that the IRS gave us on this, if you can put the words gift and IRS in the same sentence, but it's the fact that, yes, they are allowing you to invest this way. There's just a few things that you can't do, and a few people you can't do it with. So, are there any prohibited things out there on the investment? Yes. Okay. Right now, you can't invest in wines, rugs, cars that you're going to park in your on your driveway, things like that. What's a disqualified person? This one, there's going to be a booklet that you're going to be able to click a QR code here near the end. And on one of those pages, you're going to see this. And if you want it, I'll actually email it directly over to you as well. But it's what's called the disqualified parties to your retirement account. Okay. So if you just draw a line straight down your paper, a vertical line, and you put a dot right in the middle, that dot is you. So you, as the account holder, believe it or not, you are disqualified from doing business with your account. You are directing us where to send the money. Okay. We're signing off on paperwork and things like this, but it keeps you arm's length. All right. But your spouse and any entities that one or both of you control. Well, Kyle, I won't do the work on the property, but I'll just have my construction company do it. No, that they can't do the work either. Okay. Because you're going to get paid on that. Anyone in your upline to infinity and anyone in your downline and their spouses. Okay. All of those are disqualified people to the account. You cannot loan money to your child out of your account. You cannot buy a condo at the beach and put your parents in it as a thank you for everything else they've done for you. Okay. They're prohibited to the account. So not only can you not give them the money, but they can't have anything to do with any of the properties or be a benefactor in any way. And then here too, can you reside or work on a property? No sweat equity and no self-dealing. So here's where we get into all you folks on this video here. You cannot broker your own deals when your self-directed IRA is going to hold the property. If your spouse is the attorney, that y'all are a great team. They can't draw up the paperwork. Okay. And I also tell folks this: look, it's your hard-earned dollars that you have worked for. So always keep your accounts clean, because you do not want to do something that, if you know that you're doing it wrong and you don't ever fix it, you don't want to blow up that IRA, because it's, depending on the situation, it's not just that the IRS can ding you on the, well, they did their own lawn maintenance on the property or they painted their own property, something like that. They're not just going to ding you on maybe that $2,000 expense that you thought you were saving. They can blow up your entire retirement account, and that can get really pricey. Okay, because they're going to distribute the whole thing. Then you're going to get taxed on that, and then because they're the IRS, they might penalize you on that as well. So here's one of the things I was talking about, is that how does this really apply to me? Well, let's just say that, you know, I have a really good friend here, well, in the Asheville area where I lived for a couple of decades, who I managed a lot of his properties when I was the broker in charge of a property management company. Now I'm over here at American IRA. And about 8 years ago, he comes to the door and he's all excited that he's got an account here as well. He's glad that I'm working over here and doing what I'm doing. And he was telling me about a real estate deal that he's getting ready to put together. And so I just kind of chatted him up and I said, well, I know how you take care of your properties, and you know that you can't be the hands-on one that you are with all the other stuff, right? And he's like, well, what do you mean? I'm like, well, you can't put in sweat equity when you are using your self-directed IRA. And so he says, well, that doesn't sound like something that I'd be interested in. So he's kind of just sitting there scratching his head. And I said, well, I said, you can actually get into lending. You can keep getting your hands dirty on your properties that you've had outside of your IRA, right? But maybe you take those retirement dollars, and there's other people that want to be like you, but they might not have the capital to get started. So you can lend that money out to folks like that. Ends up where he has been a great hard money lender, private money lender out of his retirement account. And that's the only thing he uses his self directed IRA for. So that way he gets to continue on with what he was doing outside of his IRA. And then he's got that how he pivoted to go from real estate to lending. He gets the best of both worlds on that. So I just wanted to throw that out there. So, what does it really look like when somebody now is going to buy a house with the IRA? Okay. I'm going to give you a very vanilla look at this. Obviously, there are some scenarios that are going to be that are going to take a little bit more conversation, but just know that, and I'm just going to talk to you about this really quick, is if your IRA buys a property 100%, okay, then on the offer to purchase and contract, that buyer line right there, the IRA, New Vision Trust Company, CFBO, John Tripp, traditional IRA or Roth IRA, whatever the case may be, that's going to be the buyer line, okay? And then that is going to be the owner all the way through, not John Tripp himself, but John Tripp's retirement account. And because of that, that means that there are some differences on some things, okay? But John's retirement account buys the property. Let's say if it needs some upfitting and maintenance or whatever before he hands it over to a property management company to get that thing rented up and start generating income from the tenant occupants. Great. All of the work that's done on the property also must come from the retirement account. The retirement account owns it. The retirement account pays for everything. All right. Turn it over to a property management company, let them take care of 100% of the problems for only 10% of the rent on that. They cut the net checks and they get it back to American IRA where we deposit that into your retirement account. The question that I get is, okay, so like if I buy this with my retirement account, I need to get the money back into the retirement account, right? It must come back to the retirement account, and the ways that you are going to narrow that funnel to where you're not touching any kind of money, that's exactly what you want to do. The minute you start touching money, it becomes a taxable event. Okay. So just keep in mind that how did we get to where we are now? So you've got money at a 401k, you've got it at an IRA out there. You are going to open up an account, and you'll see how simple that is in just a second. The funds come in, or the account gets created. The funds come in. Now your account is established, and you didn't touch the money going from them to us. Okay. No taxable event. Then you directed us to send the money to wire the funds to the attorney's office at closing. Okay. You didn't touch the money on that. Now, as that thing is income producing all the time, the tenants are sending the rent in, property managers are sending the rent in, whatever the case may be, all those funds are coming back in. You didn't touch those funds in any direction, just like you're not touching the funds, when you're buying Apple stock. Well, now you're buying Apple Street, and there's no taxable event because somebody else is handling the money and it's in the vacuum of the IRA. Well, now what does that look like when you're doing a loan to somebody? Same type of thing, okay? You're going to have a meeting of the minds with a borrower. And by the way, keep in mind, you want to do your due diligence on a borrower the same way you're going to do the due diligence on a property. What kind of, how are they on their payment history? Do they get everything in? Is this going to be a secured note, an unsecured note? Okay. The attorney draws everything up. You do the packet of the investment just the same as you would a house. And again, how all the packets work and the transaction paperwork, that's something that you can find out, that your client can find out when it gets to that transaction stage. But just like the house, there's the note, or there's the money that goes to the attorney's office. The attorney cuts the check or whatever to the borrower. And then you're charging the borrower, any of the percentage that you want. It's got to always be at least a commercially reasonable rate. But we actually have clients that will look at their fees that might be associated with having the self-directed account, and then they'll even build that into the note. Borrower knows that, but they're fine with that because they know that they're getting, a solid funds coming from a retirement account as they're paying back in. All of that comes to the IRA. Okay. So basically, what you end up with is all these profits with zero taxes that you have to worry about. And remember, in the future, it's going to be the taxes paid on what you're taking in the form of a distribution from the IRA, and you'll be taxed on that amount at that time. If it was with a Roth, you're never going to have to worry about the taxes at all. Really quick, educational pieces here. If you want to learn about anything that's going on, there's live investors roundtables, there's live webinars that we do every Wednesdays at noon, and then we also have the podcast. You can always visit us at YouTube, subscribe to that channel, go to like us on Facebook. You'll always be apprised of all of the educational things that we have going on. And what I like folks to know is that just because it's self-directed, you're not alone on this. All right. When you call our office, we pick up the phone. There's always somebody there that you're going to be able to speak with, depending on where you are in your journey on everything. Now, I'll stop here for a second because I want to kind of go back to the solo 401k. Because whether you're doing an IRA or a solo 401k, this is how you get one open. You apply, you fund the account, then you're ready to invest. The solo 401k is the most powerful retirement vehicle out there for anyone that has their own company or no full-time employees. Okay, you can have assistants that get less than 1,000 hours a year. You can have 1099s out the wazoo, right? Because that's their own type of deal. But nobody that is a W-2. And there's three things that set a solo 401k apart from an IRA. Number one, much higher contribution limits. Okay. So let's just talk about anyone on here that's 49 and under, right? If you had an IRA, the maximum amount that you're able to put into an IRA each year as a contribution, as of right now, is $7,000 a year. Well, if you have your own company, you know that you don't have the benefit of that 401k that you can do all the matching. So you probably need a little bit of help on that, right? How about if I told you that if you're killing it in business and if the math works out, you can put 10 times that amount away in a solo 401k. So $70,000 a year is what you can put away in your solo 401k. Oh, and by the way, if your spouse helps you with the business as well, he or she can also have their solo 401k that branches out from that same company umbrella. So if you're both killing it, double it. $140,000 a year can go away before taxes. Again, I'm not the tax guru, but talk to your CPA. They'll tell you the exact same thing. Second thing that sets it apart, it's got a built-in Roth provision to it. Okay. So you can choose on the employee bucket on the contributions. You can make you can deposit your funds as traditional or as Roth or both. But since you are the company owner, now when you're coming in on that company match and dropping that into that bucket, then those can only be traditional. Okay. You'll want to talk to your CPA about, hey, I've heard that I can do conversions from those traditional dollars into that, Roth bucket as well. Find a CPA that, again, understands the nuances of solo 401ks and how that point can work. The third thing that sets the solo 401k apart from IRAs, but also is the only retirement account that will allow you to do this, is that is the only account that will allow you to loan to yourself for any reason. Now, remember, you're like, yeah, but Kyle, I'm a disqualified party. That's why it is the only retirement account out there that allows you to loan to yourself for any reason. You still got to pay it back. It's going to be amortized over 5 years at a commercially reasonable rate, but up to $50,000 or half of the account's value, whichever is less. So if you've only got a $30,000 account right now, or call it 32,000, because you need to keep at least a minimum cash balance of $1,500 in there at all times. You know that you're only going to be able to lend to yourself roughly 30,000. Okay. Transparent fees. I'm throwing this in there because this is great for you to have. You can scan this QR code. This is great for you to know. These fees have not changed. Well, I've been here for almost a decade, and they're the same. I do know that they haven't changed in the decade before that. So in almost 2 decades or just over 2 decades, one thing about American IRA, now this is just the IRA fees. Take those numbers right there for a solo 401k and add $300 to them. So 585 and 750. And that's because that's the plan docs that we're also putting together as well. Okay. And see that minimum cash balance there of 750? That's all somebody has to have in an IRA with us at any given time. 750 bucks always has to be in there in cash. 1500 for the solo 401k. This is the entire fee schedule. I get calls all the time from folks from other companies saying, "Hey, yeah, but what are your hidden fees?" And so much so that at the end of the summer that it's let me know that I even know where to find their escalation of fees at those companies, but they're making it so hard to find now, and then folks are finding out about it after the fact, and that's not cool. So we let you know everything. If you ever ask us to do anything, it's right here, and that's how much it's going to cost. Okay. But no matter how much your account or your client's account grows in value, we do not increase the annual fees to offset that because we didn't have a part in that, right? I think we're the only company that can really say that. So, not what you make, it's what you keep. These are the downloads here. There's that little magazine I was telling you about. There's we're getting near the end of the year yet on the changes on IRS regulations, but you have those as well. So I know that we went through the presentation, and by the way, I don't have a hard stop at 11. I know some folks might have to hop off. I don't know what it is for y'all. I am here. If you want me to answer questions for an hour, this is y'all's time. It's my pleasure. So I just want to give you this screen really quick here because this is my direct contact information. If anybody would like to email me and say, "Hey, I saw you there," I tell you what I'm going to do. How many folks do we have on here this morning, David? Can you tell?
Yeah, we've got 13 right now.
Okay, fantastic. If there are any of you that want to talk to me about an account for yourself, whether that's going to be an IRA or a solo 401k, I want you to email me and give me all your contact information and say, "Hey, we met on here. I listened to you, and I'm going to waive your setup fee." Okay. Because I want to make it part of this presentation. That's going to be my gift to you for hanging in with me here this morning and doing this on a Friday morning. So let me go ahead and open this up to any questions and see if we can take care of any of those.
Now, before we jump into any questions, is there
Sure.
anything that if we're talking to clients, other than sending them your website, is there any, PDF, brochure, something that we might have on hand if we're meeting with a client?
One thing that you can give them that booklet, if anybody wants it, and I can email over the hard booklet, or if they were able to get that there, um, you can you can definitely use that booklet. That is a great little read. It's actually our brand new one. Um, and it's got case studies in it. It lays out all the different account types. It lays out all the things they can invest in. Um, Lays out the disqualified parties. Um, Something else in there, but it's some great stuff. So that's a good thing for folks to have.
Okay, cool. Well, let's open it up. Who's got a question for
David,
Kyle?
David, another quick thing, and Kyle, I would say is just go to AmericanIRA.com. And if you hover there for a few minutes, I know there's a resources section that's fantastic, has a bunch of downloadables that Kyle's referenced. And then if you just stay on the site for a minute, you'll get a pop-up for, for a download. That's a great kind of basic resource for anybody.
And really quick, what a lot of my referral sources do, you are more than welcome to email me directly. Um, if you've got you and your client, you can do a mutual introduction email to me. I'm very fast on that. If I'm on, I can I'll be more than happy to respond back and set up a time with them to talk. I'm very accessible. I think a lot of times people, they hear people at talks or whatever, but they don't know who they're ever going to, really get to talk to when they call in. Um, but that number that I gave you, that does ring right to me, and I'll be more than happy to take care of you and your clientele.
Let's open it up to questions. Who's got a question for Kyle?
I've got something for you.
Okay.
And so obviously I don't know if you've heard or if you've talked to John, but I do some flipping and I'm really getting into it. I have a goal of doing at least 4 a year right now. I'm getting ready to purchase one. I'm ratifying tomorrow morning and hoping to close next Thursday. That's going in my company name, not me personally. So you're talking about the SEP IRAs. How does a SEP IRA get distributed from a company? And you
Okay. Well,
mentioned
hi.
about the 10 times 70K. Is that self-directed IRAs that you're putting in there into the company or?
Okay. So first of all, hi, Paula. Nice to meet you.
I,
And so one thing that we're talking about is if that is your side hustle, if that is your investment business,
Mhm.
then is it just you? Okay, with no full-time employees?
No, I did it
Okay.
just basically to protect me. It's going to be the buy and hold, sell, or flipping. That's where I've got that focus right now.
So it's your investment business. So with that, that business that you have is what you are able to use to qualify for the solo 401k. So you're not putting that property inside of a retirement account. You can't because you're using your business. That is what's generating your income. So when
Right.
you're talking about the solo 401k, it's kind of a twofer thing. I've got my business that's generating my income, whatever that is, and I'm the sole employee. Now, what you have to make sure, again, this is where your tax pro comes in, is that do you also have it set up to where I'm taxing myself? I'm a W 2 employee. I've got taxed earned wages. That's the big thing, folks, is that you got to have earned taxed wages because I'm not going to know the difference. I mean, you cut a check to put it into your retirement account. We're not going to know. All we know is that we're putting money in at your direction, right? So that investment business that you have, doesn't matter what it is. Yeah, the fix and flips and everything, that is your business, your work that you're doing to generate your income. And that income is what you are using to now make the contributions into the retirement account. And then from that retirement account, you are choosing to go out and make investments in. Now, this is important for Paula and people like Paula here. If you want to go out and buy rental property, okay, or fix and flip property because you know what you're doing with the money that you contributed into your solo 401k, it's not a revolving door. Now you've had to separate it because you can't use all of your means, or if you're doing all the work on the property, you can't use your company to manage that property. You can't use your company and your sweat equity to now flip the property that you bought with your solo 401k from funds that you used from your investment business to be able to make the contribution. Does that make sense?
My head just spinned.
So,
It's a
Kyle,
lot. It's a lot.
so are you saying that we can't list our own property?
That's exactly what, if it is, if you have a property inside of your solo four or we'll just call it your self-directed IRA, your self-directed retirement account.
Mm-hmm.
If you used that account to purchase said property, you cannot be the broker that lists it or brokers that deal. And here's why: because no self dealing, no sweat equity. If everything has to be arm's length, first of all.
Mm-hmm.
Okay. So pretend that you're not even a broker. You're just a person who has a property. That's the way you have to look at it. Do all your brokerage outside of the retirement account. But when it comes inside of the retirement account, you go to list this property. Well, guess what? You're probably cutting yourself a deal on the on the brokerage, which means that it's not you that just benefited from that. Your IRA just benefited from it. And there can't be benefits like that. Your IRA cannot benefit monetarily or personally from you, or nor vice versa. Same thing is, you can't use your retirement account to buy a condo at the beach, rent it out 51 weeks out of the year, but that 52nd week out of the year, go out and use it, go down there and use it for yourself. Even if you paid double the rent there, you can't use it for free because you obviously benefited from that. If you paid twice the weekly rent for it, now your IRA, your um, your IRA is benefiting from your personal funds. Those are the types of things that you have to get used to. If you have a construction, or if you're used to the fix and flips, if you have family members that have been doing all that in the past, they can't do all that stuff now. You have to you have to keep that arm's length. And I'll tell you this, this is another great example. And then we'll move on for clarification on that if anybody has any other questions. I got a guy on the eastern part of North Carolina. He's got a property 3 houses down from his uh, primary residence. And that house, 3 houses down, he bought with his IRA. I'm like, man, how does that work? You drive in from work at night or whatever, you see like you got a scraggly lawn, or you got a broken light, or a window with tape over it. Like what? Like how do you not want to go down and take care of that property yourself? And he goes, well, it's simple. I worked hard for that, and I pretend that that property, instead of 3 houses down, is 8 states away. And how would I be able to get that property taken care of? And that's just where he turns it over to a property management company. And all tenant knows is that that is owned by somebody with a retirement account, if they even know that at all. And for him, he just knows that that flow is going in and out of his retirement account for whatever that property needs.
So he couldn't do any of the work himself on it. He basically has to hire a property manager.
That is correct. It's not in black and white where the IRS says that you absolutely can't manage your own properties, or that you absolutely have to have a property manager. But I'll tell you this, as coming from an old property manager standpoint, the way that I used to take care of properties for my clients, I would be overstepping the bounds of what I'm allowed to do with a self-directed every 5 seconds. Okay. So, so it's just always a good idea to have a good third party out there that is managing your property for you for a little bit of the cost of the rent, and every bit of that and that way they're handling upfitting, maintenance issues, any of that, and then it's all flowing back into the retirement account.
What
Does
about
that help?
Airbnb and VRBOs?
That is something to where if you have a third party out there that can still manage those, because you can't go in and uh, and um, um, do the turns yourself. You're not stripping the sheets. You're not taking the towels. You're not taking those home and laundering those yourself. You're not taking them to a laundromat and using your own coins or whatever. Okay. You need to have a service that takes care of that, so you can have the Airbnb or the short-term rentals, but you just want to make sure that everything is being paid for from the retirement account, and any of the sweat equity is done with a third party.
Uh, Kyle, so sounds like it's a little bit more complicated if you're doing it yourself, purchasing property. Certainly with a client, it's a lot easier, it seems. My question is, say they've got 300,000 in their retirement account, but the house is worth 500,000. Or they purchase it for 500,000. Is there a
Right.
portion of that that you get to keep in monthly rent, or when you go to sell it, the equity, is there a portion that you get to keep since you didn't use uh, all of your retirement funds to purchase the property, or how does that work?
So that's a great question. And really what it comes down to is, well, then how's the other 200,000 going to be paid for? Right. And so you have options, like, where's that money coming from? Now, obviously, the person you heard me say earlier that they cannot partner with it, or that they can't do any business with themselves or with the IRA because they're disqualified. However, and here's the big but, underlined bold print, um, at the time of acquisition, and only at the time of acquisition, can someone um, use their personal funds to partner with the um, IRA to invest in that piece of real estate. Now that's really important because on the buyer line now, it's got to specify down to the nickel, down to the penny, and the percentage of ownership, who's going to own what. That percentage now will also flow the entire way through the entire ownership of the property, that any of the upfitting and maintenance that we talked about earlier that would be paid 100% from the retirement account, now whatever that percentage is going to be paid from the retirement account. The other percentages are going to be paid from the person's own funds. Okay. Then on the turn, whether it's profit coming back in the form of rent, tenant is writing two checks, or tenant writes one check into the property management company. The property management company cuts one check to the individual, cuts one check to the individual's retirement account. Okay. It has to be laid out like that to keep it separate. Okay.
So
The other way,
I'm sorry to drill down on this. So
no,
say
no,
it's 75% is coming from the retirement account and you fund the other 25% out of a money market account. From there
right.
on out, it's a 75-25 split, whether it's monthly rent or the cash out at the end.
Exactly. Exactly. So the 25% has to go back to you personally. The 75% has to come from the retirement, or has to go back into the retirement account. Absolutely.
Okay.
Now, there's another way this can be done. It's what's called, you can leverage with a loan. Okay. The only type of loan that someone can get when using a self-directed IRA is what's called a non-recourse loan. And if somebody is not familiar with that, it's a loan that basically states that you are not the guarantor. You can't sign anything. There's no, credit history based on you as the individual. Everything is based on the retirement account. It also means in the event of a default, the lender only has one remedy, and that is to take the property back itself. They can't come back after you personally or the remainder of your retirement account to make themselves whole. Now, this is important to know really quick for somebody who's considering something like this. If you do a non-recourse loan when using a self-directed retirement account, you could be subject to what's called a UDFI, or an unrelated debt to finance income tax. And you're going, how can I be getting taxed when I'm using a retirement account? Well, because in this case, if we went by David's numbers there, 25% of that purchase price didn't come from retirement funds, qualified funds. They came from a bank somewhere, right? And so that means that 25% is not going to be taxed when it comes in to go purchase the property. But as the profits come in year after year, 25% of those profits could be subject to that taxation. Now, the one good thing I'll tell you is that anybody who does this does the exact same scenario, but using a solo 401k is not going to be subject to the UDFI taxation. Okay. Again, these are very, quick answers on things for really drilled down conversations. You have my contact information. I want to make sure you have all the information necessary for you and for your clientele.
Other questions?
Wow, that's it.
Come on.
Are there transfer fees, like where it's coming from, or is it just dependent on where it's coming from?
You would really you'd want to talk to your outbound on that, because I don't know what they would charge. I would say that, like if you opened up an account with us, if they wired the funds into us, there would be the $30 wiring fee. But if they ACH'd or sent a check in, we process that on our end for free. So technically, when you think about it, you could, since I'm waiving your setup fee on this, you, Kim, could open up an account. Um, you could, we would waive your setup fee if you wired the funds in, say, from Schwab to your new American IRA account. That would, you would pay that. You'd be billed for that $30 wire fee, again, just on our end. But then we also don't have any annual fees on cash only IRA. So you're not paying an annual fee until the day that you actually do your first movement of money.
Kyle, what would be the thing that we would tell a client to say, here are the advantages of doing this as opposed to leaving it in your, 401k or IRA?
No, great question, because some of them are going to be concerned with the one question I do get is, oh, well, I want the depreciation and this and that and so on and so forth. Totally get it, right? Totally get that. Um, it's a mindset. It's a there's it's a this is do that, but this is also another way to do it that, and especially if you talk to the investor who has been doing this before, they may have two or three houses. They know they're getting taxed at the end of each year on that income, right? Well, then imagine if you say, well, by the way, you know that there's another way that you can do what you're doing. Keep doing what you're doing with those properties. There's another way to do the exact same thing and not have to worry about any taxes at the end of any year after that, even if you sold the property, if they were doing fix and flips. And when they hear that, what do you mean? Like no taxes? I mean that's a big thing right now. I would say that profit center is one of the biggest things, that not just the cash flow, but knowing the fact that they don't have to pay the taxes. That's what's huge. It is the absolute tax benefit that they don't have to worry about when using this. And again, like I said, if they're doing a Roth, they're not going to pay taxes ever.
You may have answered this. So say you're doing Paula's flip. We're not able to list the property, so we would have to hire somebody to list the property for us.
Yes.
Okay. But we couldn't take a referral fee from that.
I'm not going to know when those things are happening, but I will tell you that anything that, when using a self-directed retirement account, anything that could bring you any personal benefit at all when brokering a deal that's inside of your retirement account is considered prohibited in the eyes of the IRS.
Okay.
This
What if
is
there's no
why a lot of
monetary, what if there is no monetary benefit or funds that are exchanged? Because I will say, obviously, I think most of us are all realtors here, so we've got that interest. I think some
Mhm.
of us are investors, so it kind of goes against their grain. Like, why am I going to have to hire David to sell my property, right? I mean, but it's a reality that we need to
it,
talk.
it's
Yeah,
it is yeah.
if there's
Yeah.
no compensation that's given to us for selling our property.
There's the self-dealing and the sweat equity that goes into it. The only thing I can say is this, is that if the IRS wanted to conduct any type of audit on anything. Now, and this is way beyond me. Like
Mhm.
I would never even know this at this point on the sales deck, right?
Right.
But if they go in and they're like, well, who brokered the deal? Like there should be brokerage uh fees associated with the sale of the property. We don't see any of those. Well, I brokered it myself. Well, you know that you can't do that. You know, because if your IRA got off free, see, you did the work in self-dealing or going out there and banging the sign in, putting in the sweat equity, and then so there's that sweat equity, but then the IRA didn't have to pay for anything. And that is some of that mindset that I've said a lot of our real estate brokers that are account holders, we have a lot of real estate brokers that are our clients. But at the same time, that's where someone go, oh God, I just can't believe that I've got to let somebody else broker this, or I absolutely can't do this. Well, they end up being great private money lenders. But then others realize, hey, I've got a guy that does this, you know, charges me a little bit for it, because you can't look at it when you make that break and just say, hey, this isn't just my personal money. It's my retirement account, and it's got some parameters to it, and I got to adhere to it. Yeah, I hate it because I'm a real estate broker, but that's the difference. Um you are benefiting your retirement in the future, not just your checking account.
The
So
gloves
is
are
that
all,
why you use a hard money lender for this money and not an IRA so that you can actually sell it yourself?
Well, yeah, I mean, there's that if there's things that you just absolutely want to do yourself,
That's
then
what you
you
can help
can.
us with. You have all those people with all this money that's doing all this and needs some help. I need to know them.
Yeah,
Yeah.
but what he's saying,
Feel you.
Paula, is when you go to sell your property, you're paying taxes on it, the profit that you're making. What he's proposing is there's no tax.
Right.
If I use a self-directed IRA that I'm investing into the property, into the flip though, right?
You have
Correct.
to use your self-directed IRA, not somebody else's.
I know that. I know.
Yeah.
I know.
So this really works a little bit better for us control freak realtors for our clients who want to help them buy a property, get paid on it, help them sell the property, get paid on it.
So let me inject here because I am a somewhat a control freak, and I'm also the
Yes, we
person
know that.
who suggested Kyle on because I'm a client. I am, I've made no qualms about that. Yes, there are things there are no-nos. You can't do this, you can't do that, you can't, do such and such. I think it's in our best interest to know that, right? To know our boundaries, but not necessarily to focus on that, but look at what we can do.
Right.
I have 3 houses, and I just bought 26 acres yesterday through my self-directed IRA. I mean, am I going to have to use somebody else? Sure, I have. I have used other agents and stuff. So I mean, if it's something that, some of you guys, Christine, I'm looking at you, West Virginia. I mean, look, we have a great network that it may just be that we just kind of figure out what the
Cost of
deal
doing
is for
business.
somebody to sell my property, right? I mean, if we're truly looking at it from an investor mindset, we're going after the 20-30%, not the 2.5, 3%.
Mhm.
And one way I'll say this is that look, in the grand scheme of what the IRA could profit with no taxation
Yeah.
is offset by a few thousand, and that's going to be a deal breaker, then there was never a deal there to begin with.
Yeah.
Don't jeopardize your retirement account by just really what John said. And it's actually what I tell folks that now remember, this isn't Kyle's rules. This isn't American IRA. This is the IRS. And since they're all, back in the office starting yesterday, you want to make sure that you really are doing this the right way and the clean way. Again, you're using all your knowledge that you have without putting in, and again, what John said, it's not so much all the things that you can do and how you can benefit. It's just that small percentage of the things that you can't do.
Is there a
So
nice clean list of the things that we can't do that we can get our hands on? And
it's actually it's actually in the booklet. I mean,
oh, is
look,
it?
yeah, you can't do business with certain individuals. We already talked about that.
Mhm.
You can't have sweat equity on any of the investing you're doing. Um, you can't spend even one night in a property that's owned in your retirement account. Okay. Um, can't broker your own deals. It's not a broad list. No self dealing, no sweat equity, no dealing with prohibited individuals, and that's really in the grand scheme. Now it can branch out from there, but those are the pillars.
And another thing to keep in mind, Kyle, is we're talking about retirement funds.
Hmm.
What you can and what you can't do with that separate pot of money if you look at it like that.
Hmm.
We're, because I'm doing the same thing. I've got my retirement accounts, and then I've got my investment properties that I own through my
Hmm.
business that are separate from that. And I have learned kind of I can't I had this conversation with Kyle. I would have loved to sold my properties that I have in the Damas Group LLC entity over to I can't. Right.
Yeah,
Okay. So suck it up and understand that there's two different things that you're managing. You can get your groove on whatever you want to, whatever you'd like in either of those. Um,
exactly.
I love the flexibility. And again, I understand what you can't, but there's so much more to focus on what you actually can. And we're looking at it kind of through our lenses, right? when David, you asked a question about, advising other clients and stuff. I've got clients that I've got on American IRA, and they're using those funds to lend. I did a lender deal with one earlier this year. He's also looking at using some of those funds to go buy, other properties and other things. So and I've partnered with him on a number of deals. So it's we're kind of we're making this personal and what we can and what we can't do for ourselves, but look at it on how can we expand our network and use this to for our clients and partnering with them.
Hey, guys, I'm going to stop